Good afternoon, everyone. Buenas tardes. Welcome to our final Financial Empowerment Charla for the year. I'm Antonio Tijerino with the Hispanic Heritage Foundation, and we are proud to be part of providing critical information during this time of crisis, thanks to our year-round partnership with Nationwide. As an aside, we announced that Nationwide will be once again the broadcast partner for the Hispanic Heritage Awards that are going to be on PBS on October 6th as they present, you guessed it, the business medallion to actor and successful Latina entrepreneur, Jessica Alba. But now back to the Charla. During the last Charla, we convened experts in the industry to provide tools and actionable insights regarding creating a debt elimination plan. On today's Charla, we will have Charla veteran Paul Roldan and Karen Vergara from Algen Financial Advisors to share investing strategies. Joining us today as guest speakers, we have Francisco Javier Arceo from Unidos and Natalie Torres-Haddad, who from Financially Savvy Latina, who was also part of our podcast and is amazing. They will share their personal stories, which truly will inspire you to jumpstart your journey to financial wellness. I'm thrilled to announce that Algen Financial Services will once again be offering everyone for joining this Charla their online financial literacy program for free. Definitely take advantage of that. Please use the link that's going to be shared in the chat box by our team to take advantage of that opportunity. A big thank you to our Charla speakers for providing us with their expertise, advice, and also for answering our questions as we work on getting on a better financial path during and post-COVID. And that's an important distinction because although we're in a crisis right now, post-COVID, we're going to continue to adapt because that crisis is going to linger potentially for years. And now it is my great honor to introduce my friend and Associate Vice President, Enterprise, Diverse, and Cause Marketing at Nationwide, Lou Yarbrough III. Lou, thank you, and Nationwide for your relentless commitment to our community and HHF. You, Hope, Lori, and everyone else involved have just been family to us. And again, it's not just these Charlas, it's also what we're doing with PBS in terms of being at the largest scale possible in terms of constantly reinforcing the importance of financial wellness and entrepreneurship and the power of it. So thank you very much, Lou. Appreciate you.
Appreciate you, Tony. It is our pleasure. It is, as my friend Tony told you, my name is Lou Yarbrough. I am the Associate Vice President of Enterprise, Diverse, and Cause Marketing at Nationwide. And Nationwide is honored to be a longtime partner of the Hispanic Heritage Foundation. And we're proud to team up with them once again as part of bringing you today's virtual Charla as part of our Financial Empowerment Charla program. You know, the Financial Empowerment Charla program was designed to provide access to financial experts and offer money management advice that will guide you on your journey to financial wellness, which can be especially challenging right now. Nationwide also recognizes the fact that the Hispanic community has been among those disproportionately impacted by the COVID-19 pandemic. So now more than ever, we want to show our continued support by providing these valuable financial empowerment resources at no cost to you. Today's Charla, sadly, is the last in the series of 3. We've had a great time delivering them to you. So hopefully you had a great time being a part of it as well. Where you can, today you're going to learn the basics of investing strategies. And if this is your first time and you're just hearing about the Charla program, I encourage you to visit foryourfinancialwellness.com to watch the previous Charlas and to find the podcast series that features Tanya Menendez and Natalie Torres-Haddad as well. So let's get to today. It is my pleasure and my honor to introduce one of our guest speakers today and our moderator for today, Mr. Paul Roldan. Paul is a native of New York. He received his bachelor's degree from Princeton University and his graduate degree from Harvard University. And after working at the Federal Reserve Bank as a financial analyst, he moved to Orlando, where he found himself confronted with a new economy, which kind of led him to his journey of entrepreneurship in the financial services sector. He is now the CEO of Algen Financial. And before I turn it over to Paul, I want everybody to remember one thing, and that is that Nationwide is on your side. Paul, it's yours. Take it away.
Thank you, Lou. I appreciate that. Always appreciate the gracious and generous introduction. And in light of that, I want to thank you and Tony for being visionaries. You know, what you guys have put together, have launched here, is truly an awesome initiative to really impact and help people take their lives to another dimension. As Tony's mentioned, and Lou as well, you know, times we're living at right now have really affected and will continue to affect the population at large, but particularly Latinos. So I think it's great that you guys had the foresight to start getting ahead of this and say, how do we equip people, and let's bring this information to people so that they can actually take control of this area of their lives and really take their financial lives to another level. So thank you again for being visionaries and for allowing me to be part of this. That being said, welcome everyone. It's always great to be here. We appreciate you taking the time to kind of invest in yourselves. And ironically, today's about investing. And I'm going to give a couple of disclaimers. As Lou mentioned, if you haven't seen or heard the previous two charlas, I'm going to invite you to please listen to them at foryourfinancialwellness.com because everything we've done has built upon the previous lesson. And this is no different today. Investing is an amazing tool to be able to grow financially, but it's got to be at the right time, at the right season for your life. So we've talked about how in the previous conversations, you have to have a strong foundation before you even consider investing. And this is what I tell clients when they come to see us is I've actually told them, well, you're not ready to start investing. And I'm not trying to discourage anyone. I want to take you there, but there's some elements that are critical that you have in place. Or otherwise, it's like trying to ride a bike and never having done it, you could hurt yourself. So that being said, I want to go ahead and move forward to kind of get a preview of today's agenda. Okay. And today we're going to get into the academic side and talk about investing principles. Okay, but before we do that, we like to bring folks to chat with us that have actually been living this, that have had a personal experience with the concepts that we're about to present, because we want you to know this isn't just theory we're presenting. This is real life, actionable stuff that does make a difference in our lives. So today I have the privilege of introducing two speakers. One is Francisco, who I had the pleasure of recently chatting with, and I'm going to let him inspire you with his story. Then after that, I'm going to introduce Natalie, who I actually met earlier this year, has become a friend that also has an amazing, inspiring story of a Latina that's making a difference in her life, but also the lives of other people. Then we're going to get into the school side of things and talk about some investing concepts, and then some Q&A. Q&A, I'm going to encourage you as the charla proceeds, please drop your question in the Q&A section on the bottom of your screen, okay? Don't do it in the chat because I'll be checking and my colleague will be checking the Q&A section to answer all your questions. We're gonna try to answer them as we go, but if we don't get them through the conversation, we'll have time at the end for Q&A as well. So that being said, I'm gonna let's get started. Let's go to the next slide. And I'm going to not give a prolonged introduction, but I'm going to have my buddy Francisco give you guys a bit of his story and how this stuff can make a difference in your life. Francisco, take it away, man.
Yeah, thank you, Paul. I really appreciate that. Well, first, I'd like to say thank you to the Hispanic Heritage Foundation and Nationwide for having me on. I'd like to thank the other speakers for being so extraordinary, and everybody that's here for sharing a little bit of your time with me. I really do appreciate it. So, you know, I grew up in a working class family in the South Side of Chicago. And I think similar to other Latinos, finances were a challenge. You know, I remember when I was 15 years old, the factory that my mother was working at closed down. And so it was a really hard time for our family. And, you know, on my 16th birthday, I remember one of the first things I did is I went and found a job, right? So I could help out and pitch in. And it was a challenge to really thrive in high school while kind of juggling, you know, work and then this financial stress. But luckily we worked through it, and I ended up going to college and I felt lucky. But even so, I still had to navigate, you know, not having the same sort of finances that other people often do. And so I had to work nights, delivering pizza 5 p.m. to 5 a.m., you know, and still managing school. And I felt lucky I was able to still graduate college early. And during that time, I had a major financial setback. A car broke down. It was a significant cost. And that was the first time I actually used a credit card or used credit at all. In fact, I didn't even really know what it was or what I was doing. I just knew that I could use it. And, I felt lucky that I knew that I shouldn't use a credit card. And so I paid it off quickly. I know that's not the case for some people, and that's hard, but I felt lucky that I was able to get through that. And having that access to capital was very powerful. And so, I went on to graduate school where I had my first master's in economics and statistics. And then I ended up getting a career in finance. And I felt lucky I was able to work in, quantitative finance as a data scientist for some of the biggest financial institutions in the world, like AIG, the Commonwealth Bank of Australia, and Goldman Sachs. And it was interesting because even though I was working in that finance, it was still a little bit of a struggle for me because it was still so new to me. My parents are both from Mexico, and they didn't know much about the financial system here in the US. And so I was learning as I was going. And after 8 years working in that space, I felt really lucky that I was actually able to scale and launch digital banks, here in the US and in emerging markets, and help millions of people. After my time at Goldman, I ended up leaving to start Unidos, where I thought I could uniquely bring financial wellness through all sorts of different tools and, content and resources to my community, the Latino community. And so, I wanted to be somebody dedicated to protecting and serving that need. And so it's been both a wonderful experience and a little bit of a struggle with my family, in the sense that we're learning every day to get better and better with it, because there's so much stigma around finance. There's so much concern about, is that taboo to talk about? Maybe we can't, maybe we can't. And so I'm grateful that every day we get better at it, and every day we try. And so the kind of thing that I'll say coming out of this is that we should all focus on priority number one, which is taking care of ourselves, taking care of our family, during this crazy pandemic. And then I'd also say that, the economy is starting to reflect the uncertainty of the market, right? And the uncertainty of the world. And it's been kind of trending downward with job losses. And we see that. And it's been very tough and very hard for lots of folks. And so I would say that going forward, the future is hopeful as we adapt and we learn to adjust our skills to embrace the new economy, right? And I think that the Latino community is powerful. We will do great things. We will continue to do great things. And I'm excited to see it. And, I'm very grateful to have the opportunity to speak with all of you today. So thank you very much.
That's awesome, Francisco. I appreciate that, Francisco. And when I was talking to Francisco the other day, there was a lot of things that we related to, because, this kid from the barrio who grew up, poor and not knowing all these things. And, and he was resonating with me and vice versa. And I can appreciate that sometimes we've been able to, we've been blessed to be able to grow and to learn a new way of thinking, some new tools. And yet that creates an instant dichotomy between where we came from where we are, because my mom, the other day tells me, "Ay, mijo, la bolsa abajo, the stock market went down. Are you okay?" I'm like, "Yeah, Mom, I'm okay." So she doesn't understand, and God bless her. I love her, and that's great. But it's managing the blessing of being able to grow and help her grow with me and my community as well. So I appreciate what Francisco's doing to leave corporate America and say, you know what, our people need this, and I want to dedicate my energy, resources, and time to make that happen. So Francisco, thank you so much. Really appreciate that. And speaking of passion and inspiration, I have the privilege of introducing another passionate, inspirational person to me, and it's my buddy Natalie Torres-Haddad, who I had the pleasure of chatting with several months ago in meeting and talking one-on-one. And again, talk about people who have a lot of heart to really make an impact in people's lives in this area of finances and financial literacy. Natalie, please share with us your inspiration. Thank you.
Thank you so much for having me, and thank you to the sponsors for creating this charla. I'm sad that it's almost over, but it's really a privilege to be able to do so. As Paul mentioned, I'm Natalie Torres-Haddad. I'm known as Financially Savvy Latina. I'm an international award-winning author. I actually am the host and founder of the podcast, which is bilingual, Financially Savvy in 20 Minutes. And I'm also a 2-time TEDx speaker on financial literacy. And my beginning was very humble, and it still is. I believe it's such a journey to financial wellness because it actually started more than 2 decades ago when I was in college. I was my junior year in college. I have both of my degrees in business, finance and international business. And what I started to realize is not only were all my professors all male, mostly all white, I was very few women in our classes, and let alone people of color. And what I started to be introduced is to the gender wage gap, and knowing that there's going to be a lot more challenges as a Latina to be able to succeed in the financial industry. And after working for almost a decade for real estate development firms, I wanted to go back to grad school. And when I did, I realized that higher education was definitely something that was helpful for me in my field. But I also graduated with a lot of debt, a little over $40,000 for my graduate studies. And that caused me to not only deal with depression, which I say is an understatement, but anxiety, frustration, shame, and feeling alone. And I didn't know who to talk to. Both my parents and myself, I'm actually an immigrant refugee from El Salvador. And I was raised in Inglewood. So during the LA riots as a kid, seeing what was going on in my neighborhood, I understood that financial injustices happen, and more importantly, representation matters. And the fact that there's very few Latinx being represented still today, this is what really catapulted me to study and be doing this for the last 20-something years. And so being able to share some of my story hopefully helps other people go through knowing that they're not alone. And if they are the first person to do so, I know how scary that could be. But it's important to be able to share some of that frustration. And being able to invest was something that really helped me. I actually picked a field in real estate, which was less of a discriminatory when it came to gender wage gap, because I knew that I could buy and rent and sell properties. And I did many since I was the age of 24. So that helped me a lot. But being able to give back to my community was really the purpose and what I love doing. And so I get to travel all across the country pre-COVID, but speaking to universities and these companies and being able to connect with and collaborate with such great organizations like Hispanic Hero Foundation is something that allows me to not only hopefully share the mistakes that I went through, but also to hopefully let people know that if they're going through something that I can't relate with, that they can still be that person for someone else. And like I said, representation is extremely important, and especially in times when we're trying to figure out what our best financial decisions should be. So I thank everyone for being a part of this, and I look forward to answering questions at the end too.
No, and thank you, Natalie. Again, you know, guys, I hope you understand that the scope, you know, thanking Tony and Lou again, the Hispanic Heritage Fund, of the people that are being presented here today. I mean, Natalie, you've got an award-winning author, TEDx speaker, Latina, who started from, you know, humble means and has made it there. You've got another gentleman also, Francisco, who started humble means and has worked at Goldman Sachs, AIG. This is inspiration to say, you know, we can do this. And there was a question once that said, you know, how do we, you know, grow financially if we have to overcome all the racism and all that? And yes, those are real issues. Okay. But Natalie just said something important, which is she went away that said, you know, real estate is kind of racist neutral. You know, and a lot of what we talk about investing, you know, the stock market is gender and race neutral. The numbers are numbers. So there's certain behaviors that we can adapt that maybe don't coincide with how we learned coming from other countries or our parents from other countries, but it's the system that we have to understand to be able to use it to our advantage. Okay, and that's what this is all about, empowering us to do that. So that being said, let's jump into some of the academics here and some of the resources. So today's topic is investing. We can go to the next slide, please. And as I mentioned before, it was mentioned by by Lou, I'm going to be co-hosting this with Karen. She's been instrumental in helping me share these charlas throughout. Karen is a friend, my colleague here at work. She's a CPA inspiration. Again, she inspires me every day. She was recruited by one of the big four, Deloitte, at a very young age, decided this is not what I want to do for a living, and there's nothing wrong with that. So left Deloitte to kind of follow her path to entrepreneurship, to coaching and inspiring others to, again, empower them to take control of their financial lives. So I have the privilege and blessing to be able to work alongside her. Karen, thank you for joining me once again to be able to share this story on our mission. Are you there, Karen?
I am here. Yes, thank you, Paul. And I want to just let everyone know, if you hear thunder, is because I am in beautiful Orlando, Florida, that happens to get a lot of summer thunderstorms during this time of the year. So if you get some thunder, just maybe transport yourself for a second to Orlando, Florida. This is what happens in the middle of the day during the summertime. But I'm really excited I'm excited and also a little sad because this is our last charla of the year. And however, it's almost the culmination of all the advice that we provided to you during these past few charlas. And I think a lot of people, especially in our community, have questions around investing. So I'm excited to be able to, along with you, Paul, get a little more information out to our community.
Yes, thank you. And what Karen says, I'll echo that because she's about 15 miles north of me. I'm in downtown Orlando. She's in Altamonte. So if you can see out here, it's kind of gray out there. So you might hear an echo in the thunder that happens, but we'll roll with it. As Lori said, it's part of the show. So let's jump right into this. Today, we're going to talk about investing concepts. Now, disclaimer, there is no way that in the next 30 to 40 minutes, you are going to become investing experts, okay? I've been doing this for 25 years, and I'm learning something new literally every single day. So our goal today is not for you to go out there, wild willy and start, throwing your money at investments necessarily, okay? But to understand some basic principles that you should be using, some guidelines, some parameters that you should be applying to your life as you start investing or as you continue to invest, okay? So it's going to be somewhat high level, but as Karen mentioned, this will be the culmination of this year's. I'm already hearing buzz about next year, but I'm looking forward to hearing stories of how lives have been transformed and how you've taken what we've been able to share with you and really empower and change your life and taking your finances to the next level. I will disclaim, as I said it earlier, if you haven't listened to the previous two charlas, please go there and listen to them because they are really, they set the stage and the foundation for you to be ready to maximize your path in investing. We always like to engage our audience. So we're going to actually start with a poll. So we can go to the next slide. Very simple question. Karen, the question to the audience, are you currently investing? Simple, and these are all confidential. We won't know who said yes, who said no. So please feel free to answer this question, okay? So we try to keep it simple.
And I also want to just remind individuals that if you are investing in your 401k or your retirement plan at work, you are investing. You might not feel like you're an investor, but you are. So I would say go ahead and click yes.
Yes, this includes 401k or if you have a brokerage or IRA, real estate, I don't want you to include your personal residence where you live, okay? So if you've got rental properties, those are all investments. So please feel free, we'll give you a few more seconds to answer yes or no. Again, this is confidential. So yeah, I think once you answered, yeah, I see a question to Bitcoin. If you're investing in Bitcoin, go for it.
I would say that's plenty of time for folks to answer the question. So let's check out what the answers are.
So, very good. Of over 100 people who answered, okay, 130 something people, 65% are saying they are currently investing and 35% are no. Now, this is interesting. I like to take this and kind of bring it to context. A recent study showed that Latinos in America, when they were asked, are you currently investing, whether it be in your 401k, about 31% of the population said they were, Latinos. Okay, we got 65%, so we have a much more aggressive, audience here as far as investing is concerned, which is great. Now, how does that fare with, the rest of the population? 31% Latinos versus 48% of the rest of the population are currently investing in the same study for the same demographic. So we're still needing to catch up, but I'm glad to see that in this context, in this audience, there's a lot more people investing. So maybe some of this will resound, or maybe some of this advice will help you modify and help you grow your investing strategy. So let's jump right into this. Next slide, please. I like to start with a differentiator between savings and investments. And this is going to sound very fundamental, okay? Because some people say, oh, I want to invest to buy a house in 2 years. That's not an investment, okay, or should not be an investment, okay? You're saving for a down, that's called a savings. And here's the big difference. Savings are short-term expenditures, money that you're going to use in the next 1, 2, 3 years. That's a savings. You don't want investing because investments are not guaranteed. That's the big difference between a savings and investment. Savings are stable, low risk, that when you're going to use the money, it's there, okay? Investments, the moment you come to the other side and go to investments. It's money that offers a potential for more return, but there's then risk involved for that opportunity for more return. So savings, low risk, typically guaranteed, and very liquid. Liquid means it's not hard to get at my money, okay? So a savings account, a money market account, these are types of savings vehicles, okay? Anything that's cash, okay? That's savings. You go over to the other side, investments, it's for longer term goals, typically over 5 years. Again, why? Because if I say I want to invest to buy a car in a few years and the market goes down and it takes 3 years to recover, I would have been better just saving the money in the bank, okay? And that's what you do. So investments are typically greater than 5 years, more risk involved. We're going to get into levels of risk. It's not guaranteed. And there could be liquidity restriction potential, depending on the types of investments. If you're a retirement plan, you may not have easy access without penalties, etc. Okay, so I always like to make that differentiation, because as you start putting money away, please know, are you saving or are you investing? And both are important. I'm going to refer you to a previous charla. We talked emergency reserves in a savings account. And it's not exciting or sexy because they don't really earn a lot of interest, but the point of a savings account is not to earn interest. The point of a savings account, if you can, great, that's added bonus, but it's for it to be there at the moment that you're going to use it and need it. Does that make sense? So go ahead, Karen, did you want to say something?
Yeah, I wanted to just ask, do you think it's a good idea for some folks to invest for their cars or for a down payment on their home? Is that something that they can also do, even though investments we're thinking more of long term?
I mean, categorically speaking, I don't typically recommend investments for a down payment on a home or for a car, assuming you're going to buy a car in the next 3 to 5 years, okay? Or a home in the next 3 to 5 years. If you tell me I want to buy a home in 10, 15 years, typically not the time horizon people give me, well, okay, then you might want to consider getting a little bit more aggressive with the money that you're saving to try to grow it a little bit. But that's not typically what I'm told. I want to buy a house in the next 3 to 5 years or a car. I'm going to say use a savings vehicle so you know your money's there when you need it. Good question. Now, it's interesting. Why do we invest? And there's a simple reason for this. It's because savings, as you guys know right now, and if there's any bankers listening, nothing against banking institutions, but we know savings rates are very low right now. So if you've got money in savings, you're probably earning a fraction of 1% in your savings account, okay? But there's this other thing called inflation. And inflation is the cost of things going up in price that we don't really control, okay? So what happens? The goal of investing is so you can at least keep up with inflation, or if not, exceed the rate at which prices go up, and that's called financial progress, okay? If you're not at least keeping up with inflation, you're actually getting poorer. You don't see it numerically, but you'll see this in a slide. What you can afford, as time goes by, if you don't keep with inflation, is less and less, so you're in effect becoming poorer. So look at some real examples. 1989, you know, we're talking about 30 years ago. The price of milk was $2.30 a gallon, now it's $3.50, okay? So that's about a 50% increase. Bread, 61 cents for a loaf, price, and these are national averages, okay? So price in 2018, $2.50, okay? More than triple, okay? Gas, $1.12 in 1989, and the latest statistic in 2018 is $2.90, okay? A car, a brand new car, on average cost about $12,000 in 1989. An average new car in 18. Now, I think car prices have dropped a little bit since then, but I mean, inflation continues to go up in the long term. 35,000, that's almost triple in price, okay, during my lifetime anyway, okay? A house, $100,000 is the average price of a house in 1989. Yeah, that's not gonna happen today, okay? The average price today is 222, almost 223,000, so more than double. So here's the thing, everything gets more expensive with time. Okay, that's just a natural course of a capitalistic society, okay? So our goal is to, as you know, is to progress financially, and to do that, your money has to be growing at least at par with inflation, if not faster than that, okay? Does that make sense?
Yeah, I mean, I look at this and I think 1989, that's when I was born. So this is 31 years ago when bread was 61 cents, but then now it's around 250. So what can we do about inflation if we know that's something we can't control? Is there something that we can do to keep up with inflation?
Well, and that's a great leading question, because historically inflation has averaged 3 to 4% on average, okay? It's been very low lately. That's been great. But, right now economists are saying we're expecting high inflation in the next few years. Okay, so if you say things are growing at an average pace yearly of 3 to 4%, and some things are higher than others, okay, well, you want to try to keep your money growing, income, investments, all of that growing at least at that pace, if not faster. Now, here's the challenge, okay? If we look at our family history, I mean, I had my grandma, ay, sí, yo tengo dinero bajo el matre. I have money under the mattress, okay? That sounded great because she's saving money, okay? If we can go to the next slide, but here's a challenge with that, okay? If 30 years ago, you put $20,000 debajo del matre, under the mattress, 30 years later, you've got $20,000 under the mattress, right? Assuming you still live there and it didn't, well, where I grew up, it was a concern if it got stolen, but that's a different conversation. But everything went up in price, as you saw, and you still only have $20,000. So that is not the best saving strategy, okay? If you put in a savings account, let's say you get 2% interest in a savings account, which today would be amazing, okay? Savings accounts are not giving that much today. Well, 30 years later, you would have $36,000. That's decent, okay? But it grew at 2%, barely keeping up with inflation, okay? So you really didn't progress financially. You kind of kept up to par, okay? So you lived the same as you did 30 years, and hopefully if you're listening to this channel, you're investing yourself to hopefully progress. Look at the difference. If you can earn at a 5.5% on average per year in the last 30 years, now, this doesn't represent any particular investments, okay? And you can see different examples. The stock market is average 8 to 10% on average per year, all that type of stuff. But if you could earn 5.5%, look at your money, your $20,000 became almost $100,000, okay? That's progress, okay? That shows that you can actually buy more, or consume more, or travel more, or do more with your money because your money's done more for you. So this is why, and these are some of the ideas of why we do this and why it's important to start looking to invest. And we're going to talk about some basic principles of how and what to consider when you're doing that. Okay, so if we can go to the next slide.
Before we do that, we have a question from someone and I wanted to address it. And please go ahead and start asking your questions through the Q&A. That way we can answer some of these as we go along. Jose is asking, in the same space with inflation, do you recommend investing our nest egg or high deductible, he believes FHA accounts, since we don't know if they'll ever be needed?
Do I recommend investing our nest egg or high deductible accounts if we don't know they'll be needed? I'm not sure I understand what high deductible accounts mean.
I think what they're saying is, should they be investing in the retirement accounts? Should those be the FHA? Should those be invested as well? The health programs. Okay, got it. I'm thinking FHA loans. I was helping somebody with a mortgage earlier today. So when you said FHA, I was thinking mortgages. Okay, so two things. Retirement accounts, assuming yes, typically retirement accounts should be invested, okay? More than one reason why. If you're young, you've got time to build it, okay? If you're entering retirement, depending on your health, you might, as life expectancies increase, you're not gonna need it all year 1 through 5. You hopefully will leave another prosperous years in retirement. So you're gonna have a greater than 10-year time horizon. There should be some level of investment. Now, how you invest it, we're going to talk about that on issue number 3, which is asset allocation. You might be more conservatively invested depending on how much time you have and all that type of stuff. So those are a lot of considerations, and it's hard to answer specific questions because some of these answers really depend on your personal situation. What's your tax bracket, things of that nature. So I'm going to stay very high level, so I'm not going to necessarily direct it to FHAs and FSAs, because those depend on your particular circumstances. But like HSAs is a health savings account. Those are phenomenal. I think they call it the triple whammy of a benefit that you get if you have access to an HSA, but most people don't know about that type of stuff. So yes, for the most part, tax deferred accounts for retirement should be invested versus saved because it's a longer term proposition, whether you're accumulating or you're already spending, but you have many years to spend it down. Is that a fair answer, Karen? Yeah, and I think at the end of the day, it's just we know all about the dinero debajo del colchón, right? We hear that from our grandparents, from our mom. I mean, my mom will still have a stash of cash in her house at all times, and she just will not put it in a bank. So I think it's a matter of understanding, and that's what you're going to go into, the things that we need to consider as we learn about investing and feeling more comfortable with investing. Then we're going to start feeling like, okay, these are all accounts that can actually go into investing and then, you know, help you with inflation and all the other things that you've shared so far.
That's right. That's right. Thank you. Keep the questions coming. I appreciate that. So as you see on your slide, these are the 4 basic categories and considerations that we're going to talk about, okay, when it comes to investing. So let's get through this, because I know it's already 4:34 my time. So the first consideration is time horizon. You've heard me say this already. If we can go to the next slide. How much time you have really determines how you can invest, okay, and where to invest or save, okay. So we tried to put this on a slide. It's a lot deeper than this, but if you go to the next slide, you can see how your time horizon affects where you should be putting your money, okay? So I divided it, and Karen and I did the short-term, mid-term, long-term. Short-term defined as 0 to 5 years, mid-term 5 to 10 years, long-term greater than 10 years, okay? So if you start thinking of monies in those types of buckets or time frames, then underneath that you see what accounts typically make sense for those particular timeframes. So again, if you've got an expenditure coming up in the short term, you know, in 0 to 5 years, you should probably be using money market accounts, checking accounts, savings, CDs, those types of things that are not going to get you a wow return, okay? But that's not the purpose of that money. It's so that it's there when you're going to spend it. If you've got a little bit more time, midterm goal, okay, in 5 to 10 years, I want to buy a house or a boat or whatever, then depending on your comfort level, and we'll talk about asset allocation in a minute, okay, you might consider some type of brokerage account. And brokerage accounts are basically these accounts that you open, no cost to open a brokerage account at a wirehouse, such as Charles Schwab, Fidelity. I'm not endorsing anyone in particular, but these are types of TD Ameritrade. These are examples of brokerage houses that you can open an account and put money in it and start investing money, okay? Now, if it's for the midterm, you probably don't want to get super aggressive. Okay, you can moderate the aggressiveness by mixing what are called equities, and I'm going to talk about this in a minute, fixed income, bonds versus stocks and real estate. You can invest in all of that, but depending how long you have, you moderate the aggressiveness of the portfolio. And then long term, you can get a little bit more aggressive if you have greater than 10 years. Typically 401k, 403bs, you may, if you work for a nonprofit organization, and all those are the 401k, those are the tax code, the IRS tax code that allows companies to provide these retirement benefits to you. So IRAs, these are all long-term investments. Real estate is typically considered a longer-term investment, individual brokerage accounts, and then or starting a business. Now, I want to disclaim something. You know, these aren't get-rich-quick schemes at all, okay? Investing is typically not a get-rich proposition, okay? Most people do not become rich overnight. Get-rich propositions, I would say in my experience in 25 years doing this, are sometimes or oftentimes too good to be true, get rich quick propositions. The one thing that offers the opportunity to get rich, okay, create wealth, accelerate it, is entrepreneurship. Okay, historically, some of the wealthiest people on the planet have become wealthy in a quicker time horizon through entrepreneurship, not through investing in the stock market per se. However, about 96% of enterprises fail in this country. So, and I don't say that to discourage. I'm an entrepreneur. I encourage entrepreneurship, but there's a certain way to make that happen as well. Kind of, there's a certain way to invest. So that's a different charla maybe next year on entrepreneurship. Okay, is that fair enough, Karen? I know I talk a lot on these slides.
I know, no, that's perfect. We have some questions coming, but I think that because of time, let's just try to get to the next point, which is very important.
Okay.
It's understanding your risk profile. How much risk do you want to take? Because not everyone has the same risk tolerance.
That's
and
right.
Things happen when the market goes down. That's when we get a lot of phone calls at our office, right, Paul?
That's exactly right. You know, so, you know, risk, as we mentioned, anything that's investing requires risk, okay? And risk means no guarantee of what you put in being there when you go take it out, okay? Now, there's different levels of risk. And I'm going to show you a chart that shows different risks associated with different investment types, okay? The challenge is this. I always tell clients, the worst thing you can do is let your emotions get the best of you when it comes to investing. You know, we are a very passionate culture as a people, you know, Latinos, we can be very emotional. And that's one of our strengths, okay? We can be very passionate people. However, that does not serve us well when it comes to investing. okay? And I won't just say Latinos, this is just human nature, okay? If we look, this is what in college they teach you. They don't teach you a lot of financial principles, but basic fundamental investing principles. You wanna buy low and you wanna sell high, right? So when you invest, you hopefully buy it here and then you sell it here, the difference being your profits, right? Unfortunately, that's not what typically happens with the common investor in this country or in the world, okay? And if we actually jump to the next slide, you'll see what typically happens to most people. So if you see here, as things are going up, say it's the stock market, or say it's real estate, or say it's gold, okay? People say, wow, there's optimism and excitement. Oh, this is amazing. This is great. Look at my neighbor bought a house and now it's worth this much. Or my neighbor bought some stock. And so at the top, people say, you know, whoa, I want to do this too. Look what my neighbor, you know, the #1 financial advisor in the country is your neighbor or your co-worker at the water cooler, which is pretty interesting. But, you know, so you get this financial advice from people that may not understand your circumstances, but you get all excited. Then what happens? The biggest money flow into the stock market happened in the year 1999. And for those of you who know stock market history, 2000, 2001, 2002 were 3 years of stock market crash, okay? Real estate, biggest real estate investments in 2007, okay? I mean, you would put a house on the market and you'd have 13 offers by noon, okay? Then 2008, 2009 happens. This is what happens. So at the peak, people get all excited and start buying stuff. Okay, and we see that all the time. Again, I've seen these cycles, unfortunately, with creatures of habit. Then things start going down. Wait a minute, real estate is pulling back. The stock market is going down. Oh my goodness, this is horrible. You get excited. You know what? The bottom happens. Oh my goodness, get out, get me out of this. Okay, and this is the emotional roller coaster that we go through as human beings. And then what happens? Everything goes. The economies go in cycles. So it's interesting that right now we're seeing this articles how, you know, all these not E-Trade. What's the latest one right now? These online brokers, self-directed brokerage accounts that people are opening. Robinhood, that's the big one. Nothing against Robinhood per se, but the behaviors, people say, man, I'm making all kinds of money in the stock market. Be careful, because this is exactly what we're seeing, the same behavior that we saw in 2009, I mean, in 1999 and in 2007, repeat itself all over again with a new generation, okay? So people end up doing the opposite, and then what happens? The market itself is emotionally neutral, right? So if you look, if you just invest in the market, close your eyes and open them 20 years later, you probably did okay. But most people are watching it daily and they hear the report, the Dow Jones Industrial Average went down, you know, whatever it means, okay? And if you go to the next slide, this is what a study has shown historically. It's called the Dalbar study, okay? And it shows what an investment in the S&P 500, that's just a representation of the stock market, okay, 500 companies, how it's performed versus how individual investors have performed while investing. You see the orange constantly outpaces the blue, okay? Because of the previous slide, that emotional, oh my goodness, this is great, oh my goodness, get me out at the wrong time, okay? The stock market historically, 30-year return on average has averaged about 8 to 10%. Okay, as you see in the 30-year average, yet the average investor has averaged under 4. Okay, that's less than half than if you just did this and didn't do anything. But we let our emotions get in the way, and that's why it's very important that you understand your risk tolerance. If you're new at your investing, ease your way into the investing. Don't put it all in the stock market. A lot of people are telling me, oh, I'm up 100% this year. I'm up 200. And my business partner who heads up our portfolio management team goes, that's the worst thing that could happen to them. He shares his story. He tripled his investments when he was a young kid, his first year. It was a great year. It was in the 90s, okay? Then he lost it all the next 3 years. And this is what he did for a living, okay? He worked at a brokerage firm. There's just a lot more. Right now, everybody has ridden the wave up. It's easy. But when things start getting dicey, I'm not going to get into particular stocks, but someone told me, I want to buy this, and it's gone down 30% the last week, you know, after that person told me they want to invest in it. So you got to be careful, not let your emotions get the better of you. Karen, I think you're about to pitch a question.
Yeah, well, I was just going to, remind everyone, and it's a good point, that when it comes to investing and having that emotional roller coaster, it can happen with anything. It doesn't just happen with stocks. It can happen with real estate,
right,
stocks, in particular companies and industries, and everyone says, oh, go buy this, and everyone just flocks to get that stock, and then a year later it's worth nothing. So that could happen. We have to just be cognizant of that. I would want to ask then, if we know that emotions can get in the way of our investing and our goals, are there any ways that we can minimize that?
if you're asking me that question, it's kind of like working out, I believe. You know, the best way, the most effective ways to work out is to have a trainer. You know, those are the ones who get the best results, is to have a trainer. And this is going to sound biased because I'm in the industry and I'm a financial planner, but it's the accountability factor, you know. But if you're not going to get a trainer, it's almost turning off the news, you know, or doing the opposite of what Time Magazine, I shouldn't say Time Magazine, but, you know, I have a slide that I used to share that every time the news says this, the opposite happens. Okay, so you got to turn off the news. You just finished explaining herd mentality. If everybody's doing this, let's do it too. It's almost be contrarian, you know, do the opposite. I remember when we used to see signs here in Orlando, we buy gold and gold was the latest thing, and then gold tanked, you know. And I had a client who told me before it happened, I want to invest my whole portfolio in gold. And I told him, no, we won't do that unless you sign a disclaimer that you did it. And he waited a week, and in that week, gold dropped over 30%. Okay, so it's kind of, if you can't hire somebody to be your accountability person, then just turn off the media, focus on your education, and put on the visors with all the noise that happens in the market, because the market's bigger, honestly, than the president of this country, then who's in Congress. You know, markets got down and up with different people in power. So the economies are typically the ones that lead versus all the noise that we get to hear. Does that make sense?
Yeah, and I would say just remember that if it's for the long term, if it's something that you're putting money away for retirement and it's going to happen in 20 years, don't look at the news. What you're going to do today is not going to have such a big effect if you're retiring, you know, within 2 or 3 years. So that also helps. I tell clients, don't look at your accounts when things are bad in the news. Just don't look at them. That usually helps.
Well, it's interesting you say that, because I want to get some feedback from the audience now. It's, you know, the market tanked earlier this year. You know, we had the pandemic and all that type of stuff. So it's an election year. There's a lot of stuff going on. There's rioting. There's all kind of stuff. So I'm curious, if we can go to the next slide, I want your feedback, audience. Do you think that today, now, okay, we're September 9th, is a good time to invest? Yes or no?
2020. We must say the year 2020.
Yes, 2020. Do you think that 2020 is a good time to invest? Again, no one knows your answers. It's private, but just want to get your, you know, if you don't have any research behind it, that's fine. Just give me your instinctual opinion. Do you think it's a good time to invest now? Go ahead, click on a button. We'll give you 5 seconds to do this. Is that 5 seconds?
I think that's 5 seconds.
Okay, so survey says, it didn't show up on my computer.
Oh, well, it says that 83%, so 110 individuals have said, yes, it's a good time to invest. And about 17% said no. So majority of people say, yes, this is a good time to invest.
Okay, well, I'm glad that you feel very positive about that. Now, remember what we said about investing. Investing is for the long term. So if we understand investing is not for the short term, yes, it's always a good time to invest, because that's how you start putting your money to start, you know, compounding in your favor. Okay, so there's always people say, oh, I'm going to wait for the market to do better. Time in the market, even some of the best on Wall Street can't do it. Okay, but if you're constantly, the power of investing consistently is more powerful than most returns than what the market can give you over the long term. Okay, so that being said, we had talked about how do we invest, you know, and someone I know to put diversification of investments. That's exactly where we're going next. Thank you for that lead in. So if we can go to the next slide, asset allocation. What asset allocation means, it's what is the mix of what you own, okay? It's how you put investments in certain buckets, okay? So whether it's large cap companies, small companies, gold, oil, real estate, those are all different asset classes. And historically, they all go up and down, okay? So it is good to have a diversified portfolio, meaning a mix to offset some of the riskiness when things go up and down. Okay, now here's the challenge. If you look at asset classes, if you go to the next slide, you see different types of investments. So this slide shows you the possible returns or the expected returns with different investments, okay, but also the expected risk, okay, with certain investments, okay? So on the bottom side, you see the more conservative investments, or, well, money market's more like cash, but then you have bonds, okay, typically on the bottom end. You got real estate somewhere in the middle, and then you have stocks, equities, private equity, international small cap, okay? I'm not gonna lecture you on different types of investment, but you see that there's a wide range of opportunities when you're diversifying. Diversifying doesn't mean having many of the same thing. So for example, if you invest in a bunch of large companies, and they're all technology companies, you're not diversified. In fact, you're very risky because all you have is large technology companies. That is not, well, I have 50 of them. That is not diversification because, you know, sometimes you say you ride the wave in the market. If technology goes down, all your technology companies will probably go down, okay, no matter how good it is. So diversify means having a bit of this, a bit of that. Sometimes if it's international, sometimes it's currency, sometimes it's gold. And it's knowing when to move things around. Is the dollar weakening? Is it strengthening? And having a good diversified portfolio helps you minimize some of the risk. Understand that volatility is not a good thing, okay? People don't realize that if you, let's say, I'm gonna make math easy. If I have $100 and I lose 50%, now I have $50. In order to gain back what I had, I have to double that, right? My 50 has to become 100. I need to earn 100%, not 50%, 100% just to break even, okay? But if I had 100, it only went down to 90, okay? That means I only need 10 to get back to 100. So basically, I need about 12% just to break even, and then I'm ahead of the game. So volatility can hurt you, and that's what good diversification allocation will help minimize some of the volatility. Does that make sense? Karen, you have a question coming.
Yeah, somebody asked a good question and they said, well, just because we control your emotions and we invest money for the long term, that still doesn't guarantee our financial growth, correct?
Yes, there's no guarantees. And you'll see that in the beginning. There is no guarantees to this. All we can do is look at historical performances, what things do. Historically, the stock market has averaged about 10% over time. Okay, now, what does that mean? 1 year went up 20, 1 year lost 15, you know, all the ups and downs. So that's why investment, you have to be able to weather the long term, okay? And hopefully in the long term, the trend is upward. If you look at any stock market chart, with all its ups and downs, it's still trended upwards, okay? So you can use stock market, you can use a diversified portfolio, which is stocks and bonds, which minimizes some of the volatility. So yes, no guarantees, but hopefully better odds on your side if it's done well.
Yeah, generally speaking, it's going to be better than stuffing the money under the mattress.
Absolutely. Yeah, that's the other extreme. You're actually getting poorer if you're not investing or saving, you know, getting some type of return on your money. Okay, so doing nothing is worse than anything. Okay. Okay, so the power of this, and to that question, there's no guarantees, but if you can get the power of compounding interest, and we talked about compounding interest in the debt elimination charla because we've talked about how credit cards have become the pros, you know, multi-billion-dollar industry at having the power of compounding interest work against the consumers, okay? I don't know if people have known when they're paying the minimum on their credit cards and that balance just seems to not go down. But why? Because they're charging you interest on top of interest, okay? So that's why you want to get rid of that, we call that bad money. Get rid of anything that you're paying interest on that's not collateralized, such as a house, okay? Consumer debt, and then have the power of compound interest working in your favor, okay? That's the goal here. And if you go to the next slide, don't take it from me. Take it from this gentleman who said, compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. And who said that? A kind of smart guy, okay? Albert Einstein. So, you know, whether you relate with his social skills or not, the guy was a little bit intelligent, okay? So let's look at an example of what compounding interest can do for you along with time, okay? So here's an example. Bianca started investing at 1,000 years, $1,000 a year at the age of 30, okay, until she was 40 for a total of $11,000 total invested, and then she stops investing, okay? We're not gonna encourage you to stop, but let's say Bianca did it from 30 to 40, invested a total of $11,000, okay? At that point, okay, then Ray, a few years later, he waited, he was like, oh, I wanna have a good time. I'm 45 now, I think I should start getting serious about my future, okay? And we get this a lot. This is not a judgment on anybody who's there. We get this a lot, it's very typical. So Ray starts investing 1,000 a year, starts at 45, okay? Bianca stopped investing years ago and does that for 20 years for a total investment of $20,000, okay? So he invested twice as much as Bianca, okay? Interesting, if this grew at an average of 6% return a year, and this doesn't represent any particular investment, just using mathematical numbers, okay? Look at the difference, okay? At age 65, Bianca has almost twice what Ray has been able to accumulate, and yet Ray invested twice as much as Bianca, okay? Look at the power of compounding interest. The sooner you can start, And this is Bianca not continuing to invest. So imagine what that money would have, she would have been in 6 figures easily, okay? If she would have continued investing $1,000, it doesn't account for the fact that as we get raises, we might be able to put more away. So the power of compounding interest combined with time can really lead to financial growth, as you can see from this slide.
Yeah, and Alejandra is asking a really pertinent question regarding this. She says, what would you recommend for 20-somethings who don't have a lot of money to invest in now, but would like to take advantage of long-term investments?
That's great. And, you know, at the end of the day, yes, the earlier you can start, you don't have to start with a lot of money, okay? Literally, you can open an account with $25, okay? And if that's all you can invest every month, you invest $25 every month. You know, the goal is to start the discipline of setting a certain amount aside, whatever that is. We talked about in the budgeting, you know, a certain percentage. You know, we as a country are in the low end of the scale as far as what we save, our savings rate, you know, relative to other European countries and Asian countries. Okay, if we can get a certain percentage, and financial advisors have a rule of thumb, 10 to 15% of your income. So if I make $100, you're gonna pay taxes, right? So if you pay taxes, they're gonna force you to pay a certain percent away. Well, why don't you pay yourself first? Okay, take a certain percentage and invest in your future first. And if it's 10% means $25, but then as your income grows, that 10% now means $50 and so forth. But do it all in a good way without debt. Again, I'm going to refer you, the younger you are, if you have student loans, etc., listen to the charlas earlier, because that's a great question. I'm glad that you're young and that you're looking to get your investment started as soon as you can. Thank you for sharing that question, Karen. So if we see the power of these things, and we go to the next slide, investments come in so many forms. And again, you can Google all these things. What are stocks? They're basically shares of companies. You can own, Google, you can own Disney at a fraction of a cost. There's bonds, which are a little bit more conservative. You can have government bonds, corporate bonds. The reason I'm sharing this slide, again, is not to bore you with the details, but to get you comfortable with the language so you can start understanding. You know, some of my friends didn't even know what these were. Okay, Francisco shared a great story with me personally. When he first started working, he didn't realize he didn't have to pay to cash his check, you know, because it was his paycheck, but he didn't realize because his family never taught him that. Okay, so mutual funds, you know, what are they? A basket of stocks or bonds or combination, ETFs, REITs, real estate that you can invest in a stock market without actually owning the building. You can invest in real estate buildings through shares of real estate companies. Okay, so that's what this does. And then how do you buy these? Once you understand these and start understanding how they work, okay, how do you get these? If you go to the next slide, you can get this either through a brokerage account, as I mentioned earlier, or to retirement plans. You can get education funds for your children and invest in these types of things. So my goal here, again, is just to expose you to the language so you can start understanding these aren't, you know, a trick. These aren't a scheme. These are real tools that you can use depending on your circumstances, okay? And then the last thing I'm going to advise you on that I'm going to cover very quickly before we start getting to more Q&A is experience makes a difference, okay? And this is tough because how do you get started if you've never started? You know, it's that quandary. How do you get hired at a job for the position that you don't have any experience in? You know, it's the same thing in the market, okay? So what happens? If you have no experience, it could be very dangerous. You could hurt yourself, okay? So do a lot of reading. So how do you do this? There's different ways to approach this. And if you go to the next slide, number one is do it yourself. There's some people that get educated and they figure, let me do it myself. That's a very, be careful, okay, because you're at the whim of your emotions and of the lack of knowledge, possibly, okay? And even if you have knowledge, I've seen people let their emotions get in the way, because even my money manager, Jason, he struggles sometimes, like, oh, you know, and he's a portfolio manager who's been doing this for a couple of decades, okay, manages, you know, hundreds of millions of dollars. Another way to do this, there's a lot of companies that are coming out with what are called robo-advisors. Robo-advisors are, you kind of put in your profile and they recommend an allocation for you based on the data that you give them. And it helps you really get started on what type of portfolio makes sense for you. They'll ask you questions, your age, your experience, all that, to how much savings you have, etc., to see what type of portfolio, and then they'll give you the recommendation. You could follow that. And that's great. A lot of companies are coming out with these, okay? And then the third way is to hire a financial advisor. Okay, if you do, again, I'm going to sound very biased in this. If you do hire a financial advisor, make sure they're what's called a fiduciary. A fiduciary is bound by industry standards to put your interests first. Okay, so the robo-advisor will give you investment advice. A financial advisor will give you, hopefully, not just investment advice, but financial planning advice. So, for example, that young lady who says, I'm 20, I want to start investing. And a robo-advisor will give her a portfolio that could make sense for her. A financial planner might say, Yes, but you have all this debt. Let's get rid of this debt first and get rid of the bad money in your portfolio. They get a little deeper, a little bit more personal. Okay, so these are three different ways. I'm going to challenge our people. Okay, Karen, you know where I'm going with this. Okay, I came from a poor Hispanic family, and the mindset of my poor Hispanic family is, "Ay, ¿para qué yo voy a pagar para eso? Por eso." Okay, why am I going to pay for that? Sometimes you pay to receive value and to save yourself from getting hurt. Okay, do I know how to change the oil in my car? I absolutely do know. Okay, yet I pay a mechanic to do it, because the time that I could be doing that, I could also be learning and making more money and paying the mechanic and still having a profit margin. It's thinking almost as you're an enterprise, and where's the value so if a financial advisor could save you from yourself and give you a little bit more, that's usually worth the money, okay? And I'm gonna guide you towards, if you go to the next slide, independent company, Vanguard, very large mutual fund, they actually quantified the value of a financial advisor, okay? And they said that people who hire financial advisors typically have about a 50 to 70% higher success rate of reaching their financial goals than people who don't, okay? That to me is worth the money, okay? And I'm not telling you to hire me, okay? But just consider that wherever you're at in your stage in life, if you can get a fiduciary that's really interested in you and helping you grow, there's different areas that a financial advisor can give you guidance, and it's usually well worth the money, okay? So what is your goal with this conversation? I know I'm flying through this, Karen, but I want to get to the question. So your goal is to build long-term wealth. So how do we do that? You build a strong foundation, again, refer you to the previous charlas. Then you continue educating yourself about investments and seek to create or implement or fine-tune, if you're already investing, your investment plan by the end of this year. Let's make that a goal. Okay, if you're not starting to invest, seek to have a plan to start investing if it makes sense, if you've laid a good foundation. And if not, maybe fine-tuning what you've got going on, because I said either time is your enemy or it's your ally. I'm going to stop speaking for now, Karen.
That was great.
Go ahead.
It's 5 p.m. So I know that you we want to take some Q&A.
Well, let's do this. I did speak because it's such dense material. It's a lot. I had spoken to Karen and to Francisco and to our other speaker, to Karen, to see if they would be, and to Natalie as well, to see if they'd be willing to stay on and answer some questions. So we're willing to stay for an extra 10, 15 minutes. If that's okay, feel free to stay on if you have to sign off. But I want to invite Francisco and Natalie to join us, okay? And Karen, I know you've been seeing the questions that have been coming in, so maybe you can start throwing out some questions out there, and then we'll field them as we see fit.
Yeah, I see a lot of questions regarding how do people find someone they can trust, a trustworthy advisor that can guide them through all of the things that we just shared?
That's a great question. I don't know if I should answer that because I am a financial advisor, so that could be a biased
I think
answer.
you should. I think you're a financial advisor. You can tell us where can we find good, trustworthy financial advisors that are going to help us reach our financial goals.
If you like, we've been sending emails to all the participants afterwards, answering the questions that we're able. I will send also a list of questions to ask your advisor. You should interview financial advisors, okay? And feel free to interview 2 or 3, okay? You're gonna pay them, okay? So you have the right to know, okay, to interview them. So there are questions that you should ask every financial advisor. Are you a fiduciary? How do you get paid? I know in our culture, oh my goodness, how dare you ask that? No. How am I going to be paying you? Okay, that's a legitimate question. You know, so I will create a list, if that's okay, and send it to everyone. These are questions that you should use to screen your financial advisors, because unfortunately, as in any industry, there's some good, bad, and ugly. So if that list of questions can help you screen to get you to a fiduciary person who's looking out for your best interest, happy to share that. Is that fair?
Yeah, absolutely. There's a good question here. Someone's asking, what are some resources about understanding investing? So about understanding how to invest.
I think, Natalie, you have some great resources that I know you've shared in the past.
Yes, and actually for those that haven't seen the podcast series, or obviously going to Hispanic Heritage Foundation, we listed a lot of books and documentaries, podcasts. I mean, podcasts are free. Most documentaries you can get online, especially what's going on with the current state. And I always recommend Boom Bust Boom. There's the, especially when it comes to investing, predatory lending, I think that's really important for people of color to really find out what questions you should be asking, following up to how you said, how do you find the right advisor? So those are kind of the areas. So make sure you visit the website, because we listed a bunch of books that I think they're fun and easier to understand as opposed to the denser stuff, because there is a lot of information on there.
Excellent.
Francisco, this might be a great question for you. So Amanda is asking, can you share your thoughts about self-directing your retirement accounts to diversify your investments?
Yeah, so maybe I'll give a brief story. I didn't have a lot of money when I was 18, and it was the height of the financial crisis. And I invested I thought I was smart, buy low, sell high, like Paul said. And I bought about 1,000 shares of one stock. It was AIG. I bought it at about $1.21. The stock today, the last time I checked, which is probably a couple of years ago, was about $55 a share. But I sold it at 21 cents and took a loss. And so what I learned from that experience was that I don't do individual investing of individual stock. Now I think I'm in a position where I actually can if I really want to. I still don't. I actually go with just mutual funds or index funds, and I start small and concentrate it, right? Like I don't try to bite off more than I can chew, so that way I don't lose so much. I happen to be pretty risk averse, and besides my 18-year-old self. So I always try to say to folks to start small, manage your downside risk. And because if you want to start like investing in Amazon, Facebook, or whomever, you can do that. You can always do that through Robinhood or E-Trade or all these other companies that exist, right? But I think starting small and not losing too much money is a great way to go.
It's funny to hear Francisco say, he thought he was smart. Read his resume. The guy has, Ivy League degree, worked at Goldman Sachs, but he thought he was smart. Oh, poor guy, So, thank you for sharing that, because that speaks volumes to be careful, because what you don't know can hurt you, is what you're saying. It's not about intelligence. It's about really familiarity with it. Natalie, I think you wanted to share.
Yeah, if I can chime in, I have to go kudos with Francisco, because I started investing right before the real estate market crashed, and same thing with investing in retirement. And the things that I learned through that recession really helped me afterwards too. So, buying low is always the key, but, if those of you that are going through some financial hardship right now, whether you just lost your job or you're, trying to check out your investments, don't be so hard on yourself, because at least now you'll be prepared for the next time around. And that's partly why I feel so fortunate, where I'm like, I remember going through that and I learned a lot from that. So I didn't repeat the same mistake. So just kind of chime in on that.
And I know we have more questions, but I'm going to harp on this. I know that the allure of earning money and growing and investing is amazing, but go to a previous charla. Most of Americans don't have money to, if they have one crisis, they're living paycheck to paycheck. Okay. So before you invest, you should have an emergency fund. Emergency savings, because, if you get laid off, and I'm an optimistic person, but life happens, right? You get hurt, you get laid off, all of a sudden you're pulling out investments probably at the wrong time, so you're taking a loss. So, but if you have emergency cushions, you can survive that and let your investment do its thing. So again, refer you to the first two charlas and to Natalie's chat, because those are very fundamental to even before you start investing.
We have a question here from Toyosi. He says, or she says, are financial advisors able to help us do the government bonds, or do they just focus on stocks?
I guess as a financial advisor, or you can answer that question, but yes, financial advisors can help you buy bonds. They're not going to be the traditional savings bonds they used to buy at a bank. But you don't need to do that anymore, because now you can open an online account and buy any type of bond. So yes, financial advisors, based on your risk tolerance, should be able to help you buy any of those types of investments.
Great. So we have Isabel asking, what advice can be given to my parents in retirement given issues with the market now? My dad literally just retired. Anything he can do? So I'm not sure if maybe Francisco, would you like to answer that question?
I'll say a couple of pieces, and maybe Paul is also well equipped to answer this, or maybe Natalie as well. But I think certainly if your father is eligible for certain social security benefits, that's a potential avenue. If it's not that, then it is kind of hard to pull out money from the 401k, because it's really how are you pulling some of that out might actually mean that you're going to get less return compounding on it. So that can be a challenge. I think it is a bit of a big challenge to have to work through, and you can't really time the market when retiring. It's always a part. It's always a part of it. Some investments actually have a target date fund, so that over time you start to fund towards more risk averse portfolio, or balance your portfolio in a more risk averse way as you're getting closer to the target date. But outside of that, it's a little bit challenging.
Yeah, and it's challenging to answer that question because, it depends. You kind of have to take a look at the whole picture of where they're at, okay? So it's, what do they have? What's their risk aversion? What do they have any other income streams? But honestly, I would advise you, find someone who can do a retirement plan for your parents in retirement, not just retirement plan to project, but retirement plan now that they're in retirement. There's such things as that, okay? And it's well worth the money. I've seen people lose thousands of dollars, literally, actually tens of thousands of dollars, because they didn't realize that you can take Social Security in a different way, or if I pass away, I can leave part of my pension to my wife, but I didn't know that was an option, things of that nature. So my recommendation is sit with a professional to actually project and see what all the numbers look like, whether it's Social Security, because it's going to depend on all those available resources to them right now.
And if I may, for a lot of, especially millennials, Gen X, like we're in that situation where our parents are retiring, their first couple of years. Have that conversation with them on where you are financially as well, because that helps them also assess what their risk will be in the future, especially if they're retiring, and vice versa, because maybe you can also help them financially, or in a way that he just said. Obviously, you're sitting down with a financial professional, but having that awkward conversation right now is key, especially during this time. And it allows them to give that little peace of mind of they're like, okay, I never thought about doing that, especially if this is their first time dealing with any of the situation. And if you're a first generation or immigrant, it's a conversation that needs to be had. Don't worry about the taboos. You're going to get through that as well.
Absolutely. I think we have time for one more, Karen.
Okay, great. So let's do this last one. Alejandro is asking if high volatility is bad for investing. What about during an election year and a pandemic? So Natalie, would you like to answer that question?
Ooh, it's a difficult one to answer because well, I don't think history necessarily repeats itself, but we do see things that we emulate from the past. And so depending where you are in the country, depending on what your financial state is, I think this is more of the opportunity to make sure that you know where your financial state is, because then, yes, you're going to be able to have those opportunities to vote, to find out if it's a good time to invest. Like Paul mentioned earlier, it's always a good time to invest, but where and when and exactly how much, and obviously depending on your circumstance. So right now, I'm always going to be that person to say as well, as like, always start investing as soon as possible, but making sure where you stand, what your risk aversion will be, and really figure out fundamentally where you're going to be in the next 4 and 8 years. So obviously voting is going to make a big difference when that comes with it. Yeah,
and if I may cap off the answer by saying, yeah, volatility is hard for your monies when it's invested, but it's not bad for when you are investing. But to me, if everything's going down and I'm investing, that's great. I'm buying low. I'm buying low. So volatility can be good as if you're constantly dollar cost averaging. That's another principle that's constantly investing. So you're taking advantage of ups and downs. Regarding the other piece of the question, it's an election year, pandemic, that's more of a timing the market type of deal. You try to avoid that. It's always a good time to invest if it's for long term. If you like, I have a video that my business partner did talking about election years historically and what the market's done with a Democratic president versus a Democratic Congress, Republican president, and the market's got up and down with both. I promise, okay? So I can send you a link to that video. It's something that we do to educate our community and our clients. But yeah, don't try to time the market based on what's going on today. Have a plan and then invest in the market based on your plan, not on what's going on around you. Because there's a saying I learned many years ago from a mentor saying, I cannot control the global economy, but I really can impact my economy. So that's where you should take control of your economy using these tools. So that being said, guys, thank you. Here's what we're going to do. Karen, were there a bunch of questions left out there? I'm assuming.
Yeah, there's still some questions to answer.
Well, let's do this. If Hispanic Heritage is okay with this and Nationwide, what we've done in the past is they've sent us a list of the remaining questions, and then between the speakers, Natalie and Francisco and Karen and I, we'll get together, we'll divvy up the questions, and we'll turn them around to you guys in a timely basis so that you can have the answers to your questions. So I promise we'll get that done. And with that being said, you see the resources here of how to get in touch with us personally. And that being said, I want to turn it over again to Tony, our fearless leader. Please close this up for us.
First of all, I have to say that I was taking notes like crazy, and this is helpful for me as well as everybody in the audience. I am absolutely a participant here. And also, you know, a charla went well when you have dozens of remaining questions that you couldn't get to. It means everyone was engaged, and I was watching all of the comments swivel by. So thank you, Karen, Francisco, Natalie, and of course, Paul. For moderating this charla series, all of them. These charlas are being streamed on Facebook Live, where you can watch it again and share with your networks, because I'm sure you have primos, abuelitos, abuelitas, parents, friends that might benefit from these charlas. We will also be following up with the link today, it's a recorded session, and the resources that have been mentioned by all our speakers, because that's really important too. Nothing drives me more crazy than when people are throwing out resources and good links or podcasts that people should listen to, and you're trying to figure out where they are. So we're actually going to share those so you can get there. And make sure to visit foryourfinancialwellness.com. Again, foryourfinancialwellness.com to watch podcasts and previous resources that were made available, including the podcasts that Natalie and our friend Tanya and others have done. And do not forget to take advantage of the online financial literacy program All Gen Financial Advisors is offering exclusively to charla attendees for free. So on behalf of Nationwide, the Hispanic Heritage Foundation, all of our panelists and everyone in the audience, I want to thank you all for joining this Financial Empowerment Charla series. We hope that we've been able to provide you with useful tools and information to jumpstart your journey to financial wellness. Please stay in touch with us, because we also want to hear how your journeys are going. That continuum is an essential part of this, to see what kind of an impact these charlas have had. So please share with us that you did well, what worked for you, what additional resources we might want to know. So please stay in touch with us. We want to hear about that journey. Thanks again. Stay connected, stay safe, and stay prosperous. Thanks, everyone. Appreciate it. Thank you, Nationwide.